So looking at the Q2 2026 numbers Quest Diagnostics just dropped, it is a clear beat across the board. The headline numbers are, well, pretty staggering. Q2 revenue came in at $3.04 billion.
Right, which is huge.
Yeah, that is up 10.2% year over year, and crucially, 10% of that was organic growth. But the real standout is on the bottom line. Adjusted diluted earnings per share hit $3.12, so a 19.1% jump from the exact same quarter last year.
Yeah, and we know it is a beat of their own internal expectations, too, because management immediately turned around and raised their full-year 2026 guidance.
Always a good sign.
Exactly. They bumped projected full-year revenue to a range of between $11.95 billion and $12.05 billion. And, more importantly for the profitability metrics, they raised that adjusted diluted EPS target to a range of $11.25.
So the top line and bottom line both look incredibly robust. I mean, you have revenue up 10%, EPS up 19%.
Yeah.
But, any analyst looking at the underlying segment metrics is going to zero in on this fascinating and frankly kind of concerning dynamic playing out between volume and pricing.
Oh, for sure. The requisition volume.
Right. The actual number of test orders flowing through their system, it was up a massive 13.1% year over year. And almost all of that, like 13%, was organic.
Yeah.
So the lab network is incredibly busy.
Very busy.
But then you look at the pricing side of the equation. Their revenue per requisition was actually down 2.8%.
Right.
And if I'm modeling this out, a volume spike paired with, dropping per unit revenue usually looks like a massive red flag. It's sort of the equivalent of a retailer aggressively slashing prices just to move stale inventory out the door.
Yeah.
Like, are they simply discounting their services just to buy market share?
Well, if you only looked at the surface numbers, assuming a race to the bottom on pricing is a totally logical leap, but the management commentary completely reframes this drop.
How so?
They explained this drop in revenue per requisition as an expected mix issue. It was driven specifically by their new collaborations with Fresenius Medical Care and Corewell Health.
Okay, let's unpack the mechanics of that a bit, because it fundamentally changes how you view their pricing power.
Yeah.
Fresenius Medical Care is a giant in the kidney care and dialysis space, right?
Exactly. Massive.
And dialysis centers require a staggering volume of routine, repetitive testing for their patients. We are talking about continuous, high-frequency metabolic panels.
Right. They run those constantly.
So when Quest signs a collaboration to handle that kind of specialized high-volume lab work, the negotiated rate per test is obviously going to be significantly lower than what they might get for, say, a specialized one-off test ordered by a primary care doctor.
Yeah, it's essentially a wholesale pricing model versus a retail pricing model.
Right.
And the sheer scale of those partnerships brings in just a tidal wave of new volume, which naturally drags down the overall average revenue per requisition. It dilutes that mathematical average, even if it is, highly profitable in absolute dollars.
Makes sense.
And the crucial data point management provided to ease investor anxiety is this. If you exclude that specific mix from Fresenius and Corewell, Quest's revenue per requisition was actually up 2.9%.
Oh, wow. Okay, so the core pricing power across the broader business is actually intact.
Exactly.
In fact, it's expanding.
Yeah.
They aren't engaged in these margin-destroying discounts. They bolted a massive lower revenue per unit bulk customer onto the network that just warped the quarterly average.
Yeah, the underlying business is seeing really positive pricing action. However, managing that kind of volume influx requires intense operational discipline, which naturally brings us to the profitability metric.
Which leads right into a very pointed financial question. If revenue is up over 10% and EPS is up 19%, how did this volume versus pricing dynamic actually flow down to the bottom line?
Right.
Because when I look at the operating metrics, I see some friction. Adjusted operating income grew 7.8% to $502 million. That is a really solid raw number.
It is.
But the adjusted operating income margin actually compressed. It dropped to 16.5%, which is, down 0.4% from the 16.9% we saw in the exact same quarter last year.
Right.
So they're doing more work, processing more samples, but making slightly less profit on every dollar of revenue.
Yeah, you definitely have to keep a close eye on that compression, but you also need to contextualize it within their forward-looking guidance. Management is, well aware of the margin squeeze this quarter, yet they are explicitly stating that they expect operating margins to expand for the full year 2026 compared to 2025.
Wait, they are projecting full-year margin expansion, but in the exact same breath, they are warning about headwinds in the second half of the year.
They are.
That is a very thin tightrope to walk. Let's look at those specific risks. They flagged two areas of increased spend for the back half of 2026. First, they pointed to increased spend on Nova expenses compared to prior expectations.
Yeah, and for those tracking the internal mechanics, Nova expenses relate to their ongoing operational and system integrations.
The IT stuff.
Right. When you run a laboratory network processing millions of data points across thousands of facilities, continually upgrading and integrating those back-end systems is just a non-negotiable.
Sure.
So while their full-year expense expectations for Nova remain unchanged overall, they are cautioning analysts that the actual cash outlay is heavily weighted toward the second half of this year compared to what they initially modeled.
Got it.
Hmm?
And the second headwind is arguably more visceral, right? Higher fuel costs.
Oh, yeah.
They are projecting higher fuel costs in the second half of 2026 versus their previous estimates, which, makes perfect sense when you remember that Quest Diagnostics isn't just a bunch of scientists in white coats staring into microscopes.
No, not at all.
It is a massive, highly complex logistics and supply chain operation.
Right. It is essentially a specialized freight network for biological material. They have fleets of couriers driving around every single day, picking up blood, tissue, and urine samples from thousands of clinics and rushing them to regional testing hubs.
And doing it all at temperature scale.
Exactly.
Moving biological samples securely requires a very strict cold chain. You have to maintain refrigeration or dry ice environments in transit. If the macro price of diesel and gasoline goes up, a logistics network of this size takes a direct hit to its operating expenses.
A massive hit, yeah.
So, okay, the margin compression we saw this quarter is real. The H2 headwinds regarding Nova and fuel are real. And yet, management is still confident enough to raise full-year EPS guidance. How do they justify that confidence? Like, where is this 19% EPS growth actually coming from?
It is being driven by their advanced pipeline. Look, the routine clinical testing is still the financial bedrock of the company. It accounted for 71% of their net revenues in 2025 when you look at traditional physician lab services.
Right.
But when you dig into the management commentary for this quarter, they are highlighting double-digit revenue growth in their advanced diagnostics division.
This feels like a legacy industrial company that suddenly has this tech-like R&D division that's just printing high-margin revenue.
That's a great way to look at it.
It moves Quest away from just being the default place you go to get your basic cholesterol or, vitamin D checked during your annual physical.
Yeah, advanced diagnostics is entirely about capturing high-value, highly specialized medical decisions. Management specifically called out the growth in their Quest AD Detect blood tests for Alzheimer's disease.
Which is wild. A simple blood draw for Alzheimer's disease biomarkers is a monumental shift.
It really is.
Because historically, confirming Alzheimer's pathology required, invasive procedures like a lumbar puncture to collect cerebrospinal fluid, or incredibly expensive PET scans that most insurance plans hesitate to even cover.
Exactly. And the AD Detect test, it identifies specific amyloid beta proteins circulating right in the bloodstream, providing this highly accessible early warning system.
Wow.
So alongside neurology, they also highlighted advanced cardiometabolic and endocrine tests, specifically pointing to liver fibrosis testing. But honestly, the most significant regulatory and commercial win they detailed was securing New York State approval for their Haystack MRD test.
Okay, let's break down the mechanics of Haystack MRD, because we throw these acronyms around, but understanding what is actually happening in the lab reveals why this is such a high-margin product. MRD stands for minimal residual disease, right?
Right.
These are solid tumor ctDNA tests used in oncology.
Yeah, and the science here is fascinating. So ctDNA stands for circulating tumor DNA. When a patient undergoes surgery or, targeted therapy for a solid tumor, the critical question for the oncologist is always, did we get it all?
Right.
Historically, the standard of care was to monitor the patient with regular imaging and just wait to see if a physical mass returned. But by the time a tumor is large enough to show up on a PT scan, it has already multiplied significantly.
The Haystack test completely changes that paradigm. As cancer cells die, they shed tiny microscopic fragments of their genetic material into the patient's bloodstream.
Yes.
So the MRD test is essentially looking for a molecular needle in a haystack, literally hunting for a single drop of mutated cancer DNA in an ocean of healthy blood cells. It requires immense genomic precision.
Which is exactly why the New York State approval is such a vital catalyst. New York State's Clinical Laboratory Evaluation Program, or CLEP, has notoriously rigorous quality and validation standards.
Arguably the strictest in the country.
Absolutely. Getting approval there doesn't just open up the New York market. It serves as a gold standard validation of the Haystack test's accuracy to oncologists nationwide.
And they aren't just running these sophisticated tests in a vacuum and faxing over a PDF result to a doctor. They are actively integrating this data into the software that oncologists use every single day.
Right. The integration is key.
They announced a pilot program starting with the American Oncology Network, and they noted that Quest is now the largest reference lab to utilize Flatiron Health's Onco EMR platform.
Yeah, specifically, they integrated into Flatiron's molecular profiling integration platform for select cancer tests, and that includes the new Haystack MRD.
So for the listener who might not follow healthcare IT, an EMR is an electronic medical record. Flatiron Health builds the specific EMR software that thousands of oncologists use to manage their patient data.
Yeah.
By integrating directly into that platform, Quest is removing all the friction from the ordering process. The oncologist doesn't have to, log into a separate portal or fill out specialized paperwork. The option to order the Haystack MRD test is baked right into the software they are already staring at.
It creates a totally seamless workflow.
Yeah.
And if we connect this to the broader healthcare landscape, you are really watching a macro thesis play out in real time.
How so?
There is a massive structural pivot toward highly specialized, proactive, and personalized testing, particularly in oncology and neurology.
Right.
And Quest is positioning itself to capture the most lucrative segment of that growth. They are transitioning from just providing basic metabolic data to delivering the complex genomic profiles that dictate personalized cancer treatments.
And this shift toward proactive healthcare also plays directly into the consumerization trend. Management noted robust revenue growth through their direct-to-consumer channel, questhealth.com, as well as through their wearable and wellness partners.
Yeah, the consumer side is growing fast.
Patients are increasingly taking this into their own hands, ordering their own wellness panels without waiting for a doctor's permission, which creates a very interesting structural tension regarding their legacy business. But let's put a pin in that channel conflict for a minute.
We should definitely come back to that because the payer mix tells a very compelling story.
Yeah, we will.
Yeah.
But high-tech genetic testing is a fantastic narrative, and the top-line growth is undeniable. Let's bring it back to the financial realities, though.
Okay.
Running a laboratory network with nearly 50,000 employees, processing millions of samples, and integrating software across thousands of clinics that requires immense operational efficiency and serious cash flow.
It definitely does.
You cannot fund an advanced diagnostics pipeline on a good narrative alone. Let's look at the financial machinery running in the background during Q2.
Well, the machinery is highly efficient, and it's generating a massive amount of cash. They reported $597 million in cash provided by operations in just the second quarter alone.
Nearly $600 million in operating cash flow in 3 months. That gives a management team an incredible amount of strategic flexibility. How are they actually deploying that capital?
A significant portion went straight back into the business. They deployed $138 million into capital expenditures.
Which makes sense.
Yeah, this is a non-negotiable expense in this industry. You have to constantly upgrade laboratory equipment, purchase next-generation sequencers, and maintain these facilities to stay competitive, especially as you move deeper into these high-tech diagnostics.
Right.
But they're also heavily focused on returning capital to shareholders. They bought back 500,000 shares for $100 million in the quarter.
Let's focus on the impact of that share repurchase program because it is a vital mechanical lever for the stock. Buying back 500,000 shares physically reduces the overall share count available on the open market.
Exactly.
And when you reduce the denominator, the number of shares outstanding, your earnings per share automatically goes up, even if the actual net income of the business stays exactly the same.
It creates an artificial but, highly effective tailwind for EPS. Management specifically noted in their guidance assumptions that they expect the full-year share count to be slightly below 2025 levels, meaning buybacks will continue to support the bottom line.
That's a nice safety net.
It is. They also noted that their interest expense will remain consistent with 2025. Furthermore, their adjusted effective tax rate is now expected to be consistent with 2025 as well.
And that stable tax rate is notable because they had a favorable resolution of some tax contingencies this quarter. So the financial engineering is sound, the share count is shrinking, debt costs are stable, and tax rates are predictable.
Right.
But what about the actual operational efficiency on the floor of the labs?
Yeah.
We talked earlier about how they are fighting higher logistics expenses and fuel costs. If margins are really going to expand for the full year, how are they wringing more efficiency out of the physical workflow?
Well, they highlighted two very specific, highly granular operational moves this quarter. First, they extended their automation solutions into cervical cancer screening and front-end specimen processing across a bunch of additional labs.
Automation is huge for them.
Yeah, it's the ultimate margin expander in a high-volume environment. It drastically improves throughput productivity while simultaneously reducing human error.
And the second operational move they highlighted is even more interesting from a systems perspective. They launched a tool called IntelliDraw. My understanding is this is a digital solution designed to guide the clinical staff at their physician customers' offices through the actual specimen collection process.
Exactly.
So they're pushing their efficiency and quality control standards all the way upstream into the actual doctor's office well before the Quest courier even walks through the door.
Because the pre-analytical phase, which encompasses everything that happens before the blood vial is actually placed into the testing machine, that is where the vast majority of costly laboratory errors occur. A busy nurse or phlebotomist might, use the wrong color-coded tube for a specific genetic test, or fail to draw the required volume of blood, or maybe just forget to agitate the sample correctly.
Or store a sample at room temperature when it explicitly requires refrigeration. If a sample is compromised at the point of collection, the downstream effects are just disastrous for margin.
Oh, absolutely.
Quest incurs the logistical fuel and labor costs of picking up a completely useless vial. The doctor gets frustrated, the patient has to be called back in for another needle stick, and the entire process just grinds to a halt.
And that's why, by launching IntelliDraw and putting it right in the hands of the frontline staff, Quest is essentially providing a digital guardrail. It prompts the phlebotomist with the exact requirements, tube types, and handling procedures for the specific test ordered, virtually eliminating those costly pre-analytical errors.
It just streamlines the entire downstream process.
It does.
That is a highly intelligent structural fix that protects the bottom line. So when you synthesize all of this, the nearly $600 million in operating cash flow, the physical automation rollouts, the upstream quality control of IntelliDraw, the share repurchases, and a stable tax rate, these are the actual mechanical levers that give management the confidence to absorb higher fuel costs and still raise that full-year EPS guidance up to the $11.05 to $11.25 range.
They are. And there is one final critical note regarding that race guidance that we should touch on.
Okay.
It contains a distinctly conservative element that analysts need to factor in. Management explicitly stated that their revenue guidance does not include any contribution from prospective M&A.
Meaning they are generating massive cash flow, but they haven't baked any future acquisitions into these projections.
Not at all.
If they decide to use some of that cash to acquire, say, a smaller regional lab network or roll up a boutique genetic testing startup in the second half of the year, that revenue would represent pure incremental upside to the numbers they just put out.
Exactly. They are setting a financial floor based purely on the organic execution of the business as it stands today.
Which, considering they just posted 10% organic revenue growth, is an incredibly solid floor. Okay, we've unpacked the headline beat, we've dug into the fascinating wholesale pricing dynamics with Fresenius and Corwell, we've explored the mechanics of Fruity DNA and their advanced diagnostics wing, and we've looked at the operational levers protecting their margins.
You've covered a lot of ground.
But as we wrap up this deep dive into Quest Diagnostics, we need to return to that strategic tension we pinned earlier. When you look at the horizon, what is the structural risk that isn't necessarily spelled out in the Sunny press release? Like, what is the question investors should be pondering?
It ultimately comes down to channel conflict and the very real potential for self-cannibalization.
Right, the DTC stuff.
Yeah, we discussed how Quest is seeing robust growth in its direct-to-consumer channel through questhealth.com and various wearable partnerships. The modern patient is increasingly taking healthcare into their own hands, ordering their own comprehensive wellness panels, food allergy tests, and specialized screens without ever consulting a doctor first.
Which on the surface is fantastic for Quest. I mean, they capture that retail revenue directly at full price without having to negotiate with insurance companies or split margins.
It is fantastic for the top line right now, but you have to deeply analyze their payer mix to understand the impending tension here. Because if you look at the underlying data tables for their 2025 net revenues, a staggering 71% of their total revenue came from traditional physician lab services.
Wow. Almost 3/4 of their entire multi-billion-dollar business relies on a traditional primary care doctor or specialist physically writing a script for a blood test and directing the patient to a Quest facility.
And that is the crux of the strategic dilemma. As Quest aggressively expands its direct-to-consumer retail channels, heavily marketing questhealth.com and encouraging patients to self-direct their testing, will they eventually start cannibalizing their own massive physician referral network?
Yeah.
If patients are bypassing the primary care doctor for their routine high-margin wellness testing, how will those physician networks react to Quest essentially competing with them for that initial valuable patient touchpoint?
It is an incredibly delicate balancing act. They are trying to grow a modern, high-margin retail ecosystem without biting the hand that currently feeds 71% of their core revenue.
Yeah.
It is the classic innovator's dilemma happening right inside a diagnostic lab, and it will be fascinating to watch how management navigates that channel conflict over the next few
It
years.
certainly will be.
All right, that wraps up our deep dive into the Quest Diagnostics Q2 2026 earnings report. If you want to stay ahead of the curve and get this level of mechanical breakdown on the companies driving the market, make sure you follow the show for our daily earnings coverage. We'll be back tomorrow to unpack the next big report. Keep your eyes on the numbers,